The Bitcoin Standard Podcast brings you seminars from Saifedean.com, my independent online learning platform where you can take my online courses on the economics of Bitcoin and economics in the Austrian school tradition, join our 2 live weekly seminars, and read my books before they are published. Sign up now for access to the draft of my forthcoming economics textbook, Principles of Economics, and take 5 full online courses based on my books, The Bitcoin Standard, The Fiat Standard, and Principles of Economics. The Bitcoin Standard Podcast is brought to you by Crowd Health. Crowd Health is the Bitcoiner's answer to fiat health insurance. If you listen to this show, you've probably heard me rail against the problems of modern healthcare and health insurance. Crowd Health is a brilliant new solution to this problem that leverages the power of Bitcoin to help people get affordable healthcare. Crowd Health holds its cash reserves in Bitcoin. It negotiates with healthcare providers on your behalf and gets you much better rates by offering to pay them cash, upfront, without having to go through the expensive bureaucracy of modern healthcare insurance. It's a solution that works better for healthcare providers and for patients by disintermediating large insurance companies who have the wrong incentives and are constantly raising costs. I'm very happy to have signed up for Crowd Health, and I'm really excited to support them as they disrupt the fiat health insurance industry. Go to joincrowdhealth.com and use the discount code SAIF, S-A-I-F, and you'll get the first 6 months for $99 only.
Coinbits. Coinbits is a great way to introduce your pre-coiner friends and family to Bitcoin. Get them set up in under a minute and help kickstart their journey by turning everyday spare change into Bitcoin. This Bitcoin-only app takes the uncertainty and fear out of Bitcoin saving by rounding up debit and credit card purchases to the nearest dollar, then using the difference to buy Bitcoin. Set it, forget it, and let the app automatically tax your high-time preference spending by saving the hardest money ever. Want to save in Bitcoin faster? Customers can multiply their roundups up to 10x or adjust their savings frequency for weekly or daily Bitcoin stacking. Coinbits is built on a sound, tried and true dollar cost averaging strategy that turns Bitcoin's volatility in your favor. Once you've gotten a private wallet set up, Coinbits encourages you to withdraw your Bitcoin to your own private wallet and embrace the Bitcoin standard way of life. Start stacking on coinbitsapp.com and save your time and energy in the soundest money ever.
Get paid in Bitcoin regardless of who you work for and regardless of who is paying you. All thanks to a premium service I personally love and use, and that is Bitwage. Thanks to Bitwage, I receive my book's royalties in Bitcoin. It is cheaper, faster, and easier. It is a true set it and forget it system, and Bitwage has been offering this premium service since 2014. Anyone can sign up and use it right away. No restrictions or limits, fully non-custodial. You can even split your incoming payment. Get part in Bitcoin and part to a bank account you specify. It could not be easier, and I cannot recommend Bitwage highly enough. Go to bitwage.com and sign up now and get paid in Bitcoin with your next payment or salary. Hello, welcome to another episode of the Bitcoin Standard Podcast. Our guest today is James Lavish, who has 25 years of institutional investing and risk management experience, mainly in hedge funds and private equity. James studied political science at Yale University, executive fintech at Cornell University, and is a chartered financial analyst. More recently, he founded The Looking Glass, an all-in-one educational platform built with the intention of empowering individuals to take control of their financial futures. And he writes the Informationist Newsletter, which simplifies financial concepts for its readers. James is also a Bitcoiner, so he can help us understand the archaic finance of the fiat world while speaking the modern language of Bitcoin. He joins us today to discuss bonds and global markets, particularly the treasury market. James, thank you so much.
Thank you for having me, Saif. It's great to be on and see all your happy faces this morning.
Thank you, sir. Thank you. So I guess we could just begin with how you found Bitcoin and your journey from the world of hedge funds and private equity to shit posting on Twitter about
I know. My wife said, when people ask my wife what I do, I tell people I'm self-unemployed right now, but she likes to tell people I just shit post on Twitter. So, and it's fair.
Don't we all?
So that's a good question. And like you said, I came from the institutional investment world. And so Saif, I started actually on the floor of the New York Stock Exchange. Some of your listeners may have seen recent podcasts. I did a podcast with Peter McCormick, the What Bitcoin Did podcast a couple of weeks ago, and we went into pretty deep detail on my background. So I won't bore you guys with that here. So if you want to know more about that, you can check it out there. But basically, I was a hockey player. I got hurt, and I didn't know what I was going to do. I had student loans, and I needed to make money, and I was in New York. I got a chance to meet a bunch of people on Wall Street, and I met some people who said, well, you're pretty good at math, so what do you think about trading on the street? And I said, okay, yeah, I am good in math. So they put me on the floor of the New York Stock Exchange trading something called ADR arbitrage. So this matters because it kept me in that world of arbitrage for many years. I went to hedge funds, I traded merger arbitrage, risk arbitrage, traded distressed investing, convert arbitrage, just about anything in that arbitrage world. And what's important about that is I was always chasing a return, a spread over either the US Treasury, the Fed funds rate, or LIBOR, right? So always chasing that spread and never really thinking about the significance of that, which I will get to. And it's really important because of the Bitcoin standard and what, clicked with me when I read your book. So moving forward, I've spent many years on Wall Street, and somewhere around in the middle of 2018, I had decided I had some extra capital. I had some discretionary capital I wanted to invest. And I was looking around, I heard about this Bitcoin thing, and, it had run up over $20,000. It came all the way back. It was down around maybe $3,500. And, I wanted to dig into it. And being an institutional investor, you do what an institutional investor does, which is I tap the experts for information. And so I talked to the technology analysts on Wall Street, all the best technology analysts. And every single one of them, bar none, across the board, told me, avoid it at all costs. It's a Ponzi scheme. There's no underlying value. It's worth nothing. You'll lose all your money. And so I didn't invest in it. And to this day, Saif, that is easily the worst non-trade I've ever done. So, look, it's crashed all the way down to 16, 17,000 here. I could have bought it at 3,500 back then. Anyway, flash forward, we get to the pandemic, and I'm leaving my hedge fund private equity firm, and I'm not really sure what I'm going to do. I've been talking to my son. He's a senior at Cornell University. And I wasn't really sure what I wanted to do. And he said, Dad, a lot of my friends and I've been digging into this crypto stuff. I think you ought to check it out again. You ought to give it another chance. And he convinced me, and like we all do, he convinced me. Well, maybe you didn't, Saif, but some of the other people, I know most people did this. I bought some Ethereum, I bought some Cardano, I bought some Solana, and but this is what you do on Wall Street, right? You leg into a trade. You buy a little bit of something, and it forces you to do research on it. You have capital at risk, even if it's not a lot, just a little bit. You have it at risk, so you have to go do research on it. And so I did, and I started digging in. And about 3 weeks in, after watching some Michael Saylor videos and hearing Jeff Booth talk, and I come across your book, I was reading that, and it all just clicked, and I was like, I've got to get out of these shit coins. They're worth nothing. They're Ponzi schemes. There's no underlying value. I had to get out. So, and I moved everything into Bitcoin. And this is late 2020, early 2021. So I really haven't been in this space very long, but I've been absolutely obsessed with money, understanding the markets and how they're manipulated, understanding how money is manipulated. And that's really what brought me here. And so now, flash forward all the way to today, I'm looking at the interest rates and thinking about spread over LIBOR. And my question is, why are we even chasing that? Why do we have to chase a return to keep up with inflation? That's absolutely ridiculous. And so I've decided to dedicate the remainder of my career to this space with the Informationist. And I can't talk about it too much here, but I'm starting an investment fund that is Bitcoin focused, nothing else. And this is where I want to be. That was an insanely long answer to a "who are you" question, but
No, we could dig in much more into it, and we will dig into it more, because what I'm really interested in. I mean, I think you have a great knack for explaining fiat concepts, but I also would like to pick your brain on how the Bitcoin looking glass helped you understand fiat and
Yeah.
bonds and markets better. This is, I think, what's really fascinating about people who make this move from 20, 25 years in private equity and hedge funds, and then
Yeah, exactly.
joining the army of plebs from all over the world to the same conclusion, basically.
It's much,
I
it's
find
super
it
smart crowd that we are surrounded with, right? So, yeah, that's a good question. And so what happened was I was on one of the one of the Twitter spaces, and I was up on stage with Greg Foss, and afterwards he contacted me. He's like, "Hey, listen, we have got to talk more." So we talked a few times because we speak each other's language. We've traded the same instruments. We understand how things are valued and why it's so important to have Bitcoin as an out. So, and he said, "I'm starting this educational platform with these guys, Daz Bia and Jason Sansoni, and Seb Bunny, and you got Max here." And so he said, "I think it's what we want to do is we want to give people a place to go to first understand what money is, then understand how it's manipulated, and then understand and come to the conclusion that Bitcoin is obviously the answer." And so it's a place where, and it's a program that these guys have built. I didn't build it out. Greg and I are more just advisors. We don't do any of the hard work that all these other guys are doing. So they deserve all the credit. And they've written an incredibly, it's a comprehensive but really easy to understand program. And you sign up and you can decide. It's like a course, right? So you can take one module, you can take 5 modules. It's like Netflix. You can just binge on it if you want. But the important thing is that it's super easy to understand, and it'll walk you down that road, and it doesn't put Bitcoin right in your face right away. And I think what's important about that, and understanding where I've come from, and knowing just how difficult it is to get normal people to understand money, truly think about it, and understand why Bitcoin is different from everything else and how it solves so many problems. You have to walk them down that road. You can't just say Bitcoin's the only one, because it's almost like they bristle, right? So, and it's almost too much for them to understand at first. It was too much for me to understand at first. I mean, I'd been in investing for many, many, many years, and that probably made me negatively predisposed to the idea of something else. I mean, I had benefited from the old system greatly, and I didn't want it to change. But there's no denying that there are massive structural and unfair problems in that world. And so that's what we want to do with the Looking Glass. And it's being translated to many languages across the world, and we want it available to everybody to dig in for themselves and get to that conclusion themselves.
That's fantastic. Yeah, I think it's a really great what you guys are doing. I think it's something that's very desperately needed, because it's fascinating. Something we remark upon in this podcast very often. It's fascinating how little financial education you get in your fiat schooling education. You memorize the capitals of countries you will never visit, and you memorize parts of the different parts of the cell, which might make for a useful trivia question someday. But for the vast majority of people that are not going to be specialized in anything in biology, it's just mental exercises. It's just jumping through hoops. You need to remember what this is and what that is, and it's not really relevant for you. Of course, there's nothing wrong with learning those things, but it's
right.
far more pressing for the vast majority of people to figure out what is money, how money works, how to use it, because that determines your financial security, your survival, truly even your survival. It's a matter of life.
Yeah, and that's it. And it's evil that it's not taught in schools. One of the when my kids were young, and we would eat dinner around this round table every single night, and I didn't want to make every meal a lesson, but just telling stories and helping them understand money and investments and all that, like, back then, before I found Bitcoin, I just wanted them to understand money because I knew they weren't going to learn about it at all in school. I mean, even me being on Wall Street, I didn't, we learned, you get put in these little pods, you get put in these silos of what you're in charge of, what you're trading, what you're investing in. And unless you go out and talk to other people on the street, you don't understand all the other instruments out there. So I had no idea really how mortgages worked, the mortgage world. So the first time that I got a mortgage, I had to do my own research. There was nobody taught me anything about that, And now the great thing is that with the internet and the massive amount of information that's being printed every day, if you can find the right information and be directed to it, you can get an education. But I don't know, and I don't know, Saif. I don't know if it's intentional, but I do know that there's no real incentive for the politicians, for the bankers in charge. There's no incentive for Jamie Dimon to teach you how to invest your money, to teach you what's right and wrong with how you take on risk. He wants to manage that for you. It's his business, so the people in charge of all the money, they're not incentivized to help you understand it and how it works and just how uneven the possibilities are for the demographics of the whole world. And it's just, it's getting worse here in the United States day by day. So
yeah, I mean, the question of whether it is intentional or not is very difficult to answer. But I think what I try and argue in the fiat standard in general is that what happens to education when it's separated from the market test and when it is financed from above? It sounds like such a good idea. Like, who could be against the idea of let's just give everybody an education? Make sure that even if your dad is an alcoholic deadbeat who doesn't want to spend any money on you, you still get an education. So, and all it takes is, it's a small amount of money to secure an education for a person. Sounds like it would be the case in theory, but of course in practice we see that public schooling is much more expensive than private schooling when you measure the cost. I've seen studies on this in DC. The guy called Corey DeAngelis writes about this. It ends up being more expensive to put a student through public schools, which are performing very terribly, compared to private schools. So it is more expensive, but still, you'd think it is a nice idea because, at least everybody gets educated. But the reality of the matter is, once the financing comes from above rather than from the people themselves, then there is no market feedback for the quality of what's going on. So who determines whether people should be learning various trivia about geography of countries they will never visit, or whether it's going to be basic financial education? Well, in a free market, people who go to schools that teach basic finance would benefit and do better. And over time, they'd want their children to learn that. They'd pay more for those schools, and those schools would outcompete the other schools. But in a system where this is completely separated, where you have an enormous amount of funding that comes from above, and therefore a very powerful bureaucracy above that has essentially limitless money to determine curricula, even for public and even for private schools, which they're under the influence of government in various ways, and in universities in particular, then that feedback of the market is severed, and then it becomes very easy for education to just serve the interests of the people carrying out those bureaucratic tasks. And so instead of thinking about what's better for the student, because the student is the one that pays, and you want to get the customer back, you want them to send their kids to the school, you want them to succeed so that they tell other people, yeah, it's because I succeeded because I went to that school. You care more about pleasing the bureaucrats who pay from above. And so you don't need to posit the kind of perverse, deliberate conspiracy in order to do those things. You can just see how the incentives play out in this way. It's much more beneficial for people to go along with easy to teach nonsense. And you see this in schools and you see this in universities. It's why we end up with essentially an enormous number of pseudosciences being taught, whether it's in macroeconomics or nutrition or climate, if you ask me. There's no corrective mechanism. How do people continue to learn these things? Well, because they can, because there's no corrective mechanism that punishes them for learning absurdities and rewards them for learning things that are useful.
That's fair. That's fair. I mean, it's hard to argue against that, and Jeff Booth likes to say, just look at the incentives, and then you'll understand, what the motivation is. And it's true. The incentives are for power to be consolidated at the top, for money to be consolidated at the top. That's the incentive, and so
Yeah.
of course, and it's evil. And I think people like
Yeah.
you and me and a number of others that we're talking about here, we're done with it. I'm not going to feed into that system anymore. So
Yeah, and it's becoming harder and harder to maintain the Ponzi going, because I think, as we're going to be discussing now, it's straining at the seams as it is. So let's begin in first principles. What is a bond? Let's begin from scratch. What is a bond, and why is it a scam?
That's a good question. So, well, if you're talking about treasury bonds, a bond is just a company borrowing money from people, right? Or, I mean, it doesn't even have to be a company. You could issue a bond and borrow money because you have this podcast, you want to grow it, so you need to borrow money in order to grow that. And so, but the thing is, the time value of money, right? So if you want to borrow money from me today, well, there's a time value that's associated with that. So I need to pay you interest on that in order to make it worth it for you to not use that money today, right? So, or for me not use that money today. So you're going to have to pay me interest on that. So you borrow money from me, you pay me interest every single year, and then you pay back all that money to me on top of that interest. And so for me, I don't get to use that money today, but I get to that time value of money going forward, right? So the difference between equity and bond, it confuses people who aren't in investment sometimes, but the basic premise is that a bond is borrowing money and equity is owning part of whatever you're buying, right? So that's the first principle. And the Treasury has to issue bonds every single year because it needs to borrow money, because it's not covering its costs, because it spends too much, and it doesn't take in enough income to cover all those expenses. So that's basically the Treasury. And why is it a scam? Because if you invest money in a bond and you're giving up that value of money that you have today, if you're not making at least the inflation rate on that bond every single year, then you're losing money in real terms every single year. And that's why it's a scam. Because if you look at the interest rate on bonds, even today, with the interest rate of treasuries that are up around 4% on the 10-year treasury, well, inflation is still over 7%. So how is that? It doesn't compensate you for the inflation rate today. So you invest in a bond at 4%, inflation's at 7%, you lost 3% in real terms of your money. And so the scam is not really the bond as much as the manipulation of money to create this inflation, which has made bonds a terrible investment the last few years.
Yeah, and I think probably there's a little bit of a chicken and egg problem here in that, well, why do you need to buy bonds in the first place? Because there is inflation. Because if the money just worked, you wouldn't need a bond. The money would just be appreciating, and you just hold on to the money, and you don't have to worry about the fiscal position of the people you're lending to. And I think this is hugely underrated. And I mean, in fiat world, people think that it's a good thing, that, well, the value of the currency is devalued, but it's fine because everybody can beat inflation simply by holding on to bonds, because the bonds compensate. But and somehow it's like an archaic, old, unworkable system that compromises our ability to have economic growth if we don't have inflation. But in the 19th century, this is how it worked, and I mean, bonds still existed, but they were far less significant than they are right now as a part of the economic system, because you didn't have to. It was people in financial markets who got into bonds, but the average person just held their savings in the money that they earned. You earned the money that was either physical gold or paper that was redeemable for physical gold, and you just held on to that thing, and then it appreciated over time. So you didn't need to take on the risk of lending it out, and you didn't need to be a credit underwriter basically just to be able to save. And this, I think, is an enormously underrated fact, which this is one of the benefits of or I'd say benefits not for you, but for the people who run those schemes. One of the benefits of mass financial literacy is that people think it's normal that, you just need to become a credit underwriter and figure out the normal credit health conditions of every possible borrower in the world, and then you'll figure out who to lend to.
Right.
And that way you'll get to keep the earnings that you've already earned. You have your job as an engineer or as a doctor or as a dancer or as an athlete, and you make your money, and then you need to go do another job, which is go be a credit underwriter, figure out the credit position of Coca-Cola or the US government or somebody else and lend them, so that you take on a risk, and then there is a return that somehow beats the inflation, which I think is enormously wasteful and counterproductive, because why should you have to earn your money twice? And this is really, I think, what it fundamentally comes down to.
And then you pay taxes on that interest or that, that the capital gains that you've created from those investments. It's ridiculous.
Yeah, this is the other absurd thing.
Fortunate enough to have enough money, make enough money to cover all of your mandatory expenses, and then have some left over to invest it. But the vast majority of people, they are not even meeting inflation. They're not keeping up with inflation, right? So wages need to keep up with inflation in order for you to make enough money to outpace the mandatory expenses, right? So, I mean, it's evil. So most people don't have money to just go and invest, and they're struggling to keep up with the inflation rate. Why do you think that we have so many two income families now? I mean, how many people do you know that the wife doesn't have to work? That's just ridiculous, right? So
yeah, it's a lot more common among Bitcoiners, you'll notice, and I think that's extremely telling, because once you have this idea, well, it's not so much about having a high income as much as it is about keeping your income. If you're able to keep your income, then you can manage your expenditures in a way where you can have somebody dedicated to the house and somebody focused on earning. But if you can't keep your money, then you just need to keep putting everything you can into work,
right? And then you give your kids over to some care provider daily, who may or may not be educating them properly, may be abusing them, may be filling their heads with ideas that you wouldn't want them to have, and then you send them to public school, and you're at the whim of the system teaching them or not teaching them important life lessons and values, and that's hard. I mean, and it's where we've gotten to years. That's where we've gotten to. So I mean, how ridiculous is this, Safe? So my dad, absolute poverty in the Lower East Side of Manhattan, and in tenements down there, in Ukrainian Russian tenements. And he worked his way. He was the first guy to go to college in his first person to go to college in his family. And he worked his way to be a nuclear engineer for GE. And somewhere around the time that I hit high school, my family didn't have enough money to cover the expenses. So my mom had to go back to work. She became a nurse. That's in the 70s and early 80s. I mean, think of how ridiculous that is, that just from the 50s to the 70s, it started becoming very difficult for families not to have a single income, not to have two workers. I mean, it's just, it's so wrong. I mean, so yeah. And that's it. Not keeping up with inflation.
Yeah, that's what it ultimately comes down to. And as you said, I mean, there's so many hurdles that are put in your place that it's really very difficult to beat it. So not only do you need to be a credit underwriter, so good luck on your nuclear engineering career when you have to also study the credit ratings of so many different institutions around the world. You also need to manage your risk, diversify your portfolio, pick proper equities, because like bonds on its own obviously is not going to cut it on its own. And then I think, as you mentioned, the cherry on top is the capital gains tax. So you have to pay a capital gains tax in order to secure the gains, which are really not gains. Like the whole point is that this is just your way of beating inflation. And they're still going to take 20, 30, or maybe 40% of that as a capital gains tax. So when you think about it, it's extremely difficult for anybody to beat inflation reliably on the long run with management fees and capital gains tax. So once you take out the capital gains tax and the management fees, it's very difficult to beat inflation in the long run. And it's not just, of course, when people say inflation, they usually mean the CPI, which is
problematic at best.
Yeah, it's your measure of inflation if you're basically eating BLS baskets, which nobody is. Nobody, or at least nobody wants to be eating the BLS basket. The BLS basket is manufactured to understate inflation, and people aspire to want to live a better life. People want to live in the neighborhood with no crime. People want to live in the place that allows them to have security and peace and to send their kids to good schools.
In 5 years, they're not going to want to eat bugs. I mean...
And yeah, they're not going to want to eat bugs, which are going to come to your BLS basket very soon. And it's those things that are very difficult for people to get. Once you think of these things, you see that the inflation rate in practice is much higher than the 2-3% that's advertised. So for instance, I did a recent thread where I looked at housing prices on Zillow, which is where Americans go to buy their homes. So if you go on Zillow, you want to buy a house. I looked at the 10 major cities of the US and I looked at the last 10 years and what happened to the price of houses over those 10 years. And I did the average for the 10 cities and it was at around 8.5% per year. That's the actual inflation rate that most people are facing. If you want to live in a city, if you want to benefit from the economies of scale that come from living in modern city life, from the increased productivity of being in large labor markets, which is really what most people want to do, at least at the most productive period of their life, then this is what you're facing. Every year, the hurdle that you need to beat is 8.5%. And professional investors struggle to beat that 8.5% per year, especially if you count the management fees and the capital gains tax. It's very difficult. And every time you trade, there's a capital gains tax to be taken. And every time you change your thesis and you want to reallocate, there's a capital gains tax to be paid. So it's extremely difficult for people to maintain this and to beat it. And that's really what makes this such a difficult obstacle.
It's a challenge. I mean, it's a challenge for everybody, and that's the problem. You just hit on it. I mean, look what happened in the UK with the pension funds. I mean, people have their money invested in these pension funds in order to retire comfortably. They've worked all their lives, and they have to invest money in pension funds to retire comfortably. And in a flash, they almost saw all of their money completely decimated overnight. Why? Money manipulation, period. I don't care what anybody says. I've talked to people in my world, and their argument is that, well, the UK pension funds were just they were taking on undue risk, but they're chasing returns. They're chasing yield. Everybody is chasing yield, and that's what you're getting to here. You're chasing yield. Day after day after day after day, you're chasing yield. Why? To keep up with inflation. Why? To preserve that work that you've done all these years that you have to store in order to not work until you die. And it's just wrong. And so that's what everybody's doing. They're just chasing yield. And it makes for a not a very pleasant life, not fulfilling.
Yeah. Ultimately, this is what it all comes down to. The reason, I always say this on this podcast, the yield is the cheese in the mousetrap. And it's just, anytime you're being offered yield, you're You're like the mouse that thinks that they're being offered free cheese. And in the last week, we hosted Dylan Leclerc, and we were discussing Ponzi's in the crypto world. And again, it's the same theme. The only reason anybody gets into all of those things, like why would you put your money in something like Luna, something like FTX? I mean, it's just, if it's too good to be true, it is not true. But yet people go there because they want to chase the yield, because they've been programmed by a century of fiat money to think that your money can't just sit there. It has to sit there and also earn money. And this is, I think, ultimately the real scam here, which is that money itself can't earn money. Money is sterile. Money doesn't yield anything. You know, if you exchange the money for a productive asset, the productive asset can yield things. But fiat world wants to convince you, and this is, in my mind, ultimately it's just inflation propaganda. Fiat world wants to convince you that you can get the yield without having to let go of the money. You don't have to buy a cow. You can just keep the money, and somehow somebody's cow is going to give you milk while the money is available for you. This is the circle that they want to square, essentially, that you don't have to take on risk, and you don't have to give up the money. The money is still available for you to spend at any time that you want, but there's still a cow somewhere that's going to be making milk that's going to go to you. And there's, I think all of the history of financial crises is just people learning that this can't work the hard way, and still not learning it. They fall for this, but they don't ever accept it. They still fall for the next one. And I think in the crypto world, it's absolutely amazing. You saw Luna's collapse, and you saw all of these supposed smart money investors and the shitcoin thought leaders. They were also absolutely startled. Like, how could this happen? I can't believe it. Luna was supposed to be safe. It was risk-free. And then they took whatever was left of their money, or usually their clients' money, and then marched straight into FTX and put it on FTX Earn. And then also got shocked and couldn't believe that also their money was not safe at FTX Earn. But it's the same thing. Anybody who's offering you yield is taking on enormous risks, and these risks are not going to continue to play out properly every time. You're playing Russian roulette, and just because you won a couple of times doesn't mean you're going to win every time.
And that's the problem. If you don't know where the yield is coming from, it's you.
Exactly. Yeah. All right. So what are your thoughts on the developments in the bond market recently? So we've sort of spoken now about bonds in general. Historically, though, for majority of people, you could say that the returns on holding bond up until 2020, I'd say the majority of people in fiat world would tell you that bonds are working. Like you split your portfolio between bonds and stocks, and the bonds serve their function of basically keeping up with inflation, and then you take risk with the rest of your portfolio, and you manage to beat CPI at least.
Nominally. Yeah.
Nominally, yeah, you can beat CPI, and it looks, somehow all the things that you want are becoming more expensive, but it was possible to convince yourself before 2020 that was not an issue because you're beating CPI. But after 2020, this became much more difficult. And after 2022, over the last few months, as you were mentioning, England was a great example. And we're seeing enormous destruction in the bond market. So yields are rising, and the value of old bonds and old savings is declining enormously. So what are your thoughts on this? Why has this long-term trend played out the way that it has, and where do you see this going?
It's pretty simple. That if you looked over the last number of decades, the yields, the interest rates they've been falling, right? So, and if you own a bond and you own it at, say, 4 or 5%, and the interest rate is going lower, well, that means that people are paying more for that bond if you want to trade it in the market, right? So you're making money on that because the interest rate is lower. As interest rates go up, it's because there's less demand for that bond. And so the interest rate has to go up in order to entice people, incentivize them to buy that bond, right? So if you own bonds over the last number of decades, as structurally interest rates have been coming down and been held low manipulated low than below the inflation rate, it's been a good trade. And of course, look, there's some confusion about bonds and whether they're a good investment. Long term, I don't think they're a great investment. And we can get into that because of the problem with the Treasury and the problem with all fiat-based debt. But the just on the face of it, if you own a 2-year Treasury and it's paying you somewhere around 3.5-4%, that's probably okay as long as you hold it the whole 2 years. But if you think you may need liquidity between now and then, well, the Fed is going to raise rates again, 1 or 2 more times at a minimum. And so interest rates are going to go higher, which means that if you have to trade out of that 2-year Treasury in the next 6 or 12 months, you'll probably lose money on that. Unless the market anticipates the Fed stopping and then interest rates go back down. But if you buy a Treasury and you hold it until maturity, well, you're going to make that money because the United States government is going to pay you back what you lent them. That's in the near term, right?
Yeah, but I think the problem here is, for most retirees is they don't just spend the coupon. They have to
eat into the
draw down on their savings.
They have to eat into the principal. And so you wind up having to sell some bonds, and you're not going to hold them for the 30 years that you need to hold them in order to make that money back. So if, like the last few years, the last year and a half, 2 years, if you had a 30-year Treasury, like you're saying, and you expected to maybe, just use that interest that you're making out, you're retired, you're going to use that interest, and you might have to sell a little bit in order to meet that margin of your mandatory costs, right? Well, not only did your mandatory costs go through the roof the last couple of years, but the bond that you held, it went lower. So because of the interest rates going much higher, so now that 30-year bond is down 25-30%, let's call it 25%. And so now you're selling something that's worth, and you're cashing out of it with a 25% loss. So structurally, the problem is, as interest rates go higher, those long-term bonds are worth a lot less if you need liquidity. And then we can get into are the 30-year Treasuries going to be around in 30 years? That's a good question. I would say that we have a structural problem with our system right now, and the Treasury has entered what we call a debt spiral. And I don't know how they get out of it other than printing their way forward. And eventually it breaks. So what does that mean? I mean, we can get deep into this, Saifedean, if you want, but let's first start with, what's the problem with the Treasury? What's the problem with the bonds, and what's the debt? What's that debt spiral? Why do we call it that? Well, right now we're running a $1 trillion deficit. Right. So that means that we're spending $1 trillion more than we're taking in as a country. We're taking in, according to the Congressional Budget Office, you can go on their website, you can download all this information, and it's optimistic. Remember, this is the Congressional Budget Office. It's optimistic on what they think is going to happen with debt and with income in the United States. If you look at it today, there's a $1 trillion deficit that we're spending more every single year. Right. So, and that's with a pretty good year in 2020 when they printed all the money, asset prices went through the roof. They had a huge windfall of taxes. So if you look forward to 2023, 2024, there was about a $600 billion windfall tax on capital gains and asset inflation. Right. So take that out. Right. You start there. Now, then you look at the interest rates. Well, interest rates are much higher now. We have $31 trillion of debt, about a third of which comes off the next 12 to 18 months, about half of which comes off in the next 3 years, call it, right? And if that's the case, we have to refinance that debt. The Treasury has to refinance the debt in order to pay people for the debt that's maturing, right? So remember, we're running a deficit here. So they're not making enough money to pay off old debt. They have to issue more debt in order to pay off that old debt. So now they're going to issue that debt at higher interest rates. So let's call it somewhere around $300 or $400 billion more interest each year as that debt rolls off, right? So you've got $600 billion of windfall tax that they're not going to get. You've got about $300 or $400 billion of extra interest expense. Then you've got the cost of living, the COLA adjustment on Social Security and Medicare and Medicaid, and that adds another $150 billion just in 2023. We're not even talking about the student debt forgiveness. And whether that is even in the calculation now is unclear because it's sitting in the courts, right? But there's another $300 billion. But let's just put that aside. Let's just ignore that, pretend that's not there. We just talked about $600 billion, $300 or $400 billion, plus another $150 billion of additional, expenses or less income that the government's going to take in. So that $1 trillion deficit now becomes $2 trillion. As we enter what is increasingly obviously going to be a recession. And if that recession is anything like 2000 or 2008, the tech bubble or the great financial crisis, both your tax receipts fell by about 8 to 12%. So let's call it 10%. And your social costs, your Social Security, your Medicare, your Medicaid, they rose by 8 to 12%. You've got, because when you go into recession, you've got all these unemployment costs, and so you've got more social programs that come through, and so that's up 10%, right? So remember, your tax receipts were $4.8 trillion. So 10% of that, there's another 500. Let's just call it $400 billion. Okay. And then your Social Security costs and all your social costs are up 8 to 12%. Well, you're at $3.7 trillion of costs this year. So there's another $300 or $400 billion. So that's another $800 billion. So now you're at a $3 trillion deficit. And that's just going forward about 18 to 24 months. I mean, so what are they going to do? They're going to print more bonds. They're going to print money to buy those bonds. They're going to sell more bonds, and they're going to have to print more money to buy those bonds. Why? Because as you get to that, we're over 130% debt to GDP in this country now. Okay, so who's going to buy all these bonds? You're crowding out balance sheets that they cannot buy these bonds. So the typical players that are buying these bonds, all these huge, whether they're pension funds, their endowments, or their hedge funds, or the commercial banks, the primary dealers, like who is going to buy these bonds? You're starting to crowd out the balance sheets. So the Fed will have to print money to buy the bonds and put them on their own balance sheet. Now we're talking about, we're getting into, if you keep doing this, because the other option is to spend less money. You could do that. You could have the politicians agree to spend less money, pull down some of these social programs, pull down defense spending. That's politically not very popular. So who's going to want to do that? Neither party wants to do that. Forget politics. Both parties suck. But, where are you going to get that money? Okay. You could do that. There's only so many ways that you can do this, but it all paths lead to the Fed printing more money, So eventually, it's like, to put it in simple terms, it's like a single parent who's trying to meet their expenses every single day, and their job is not paying enough. So they have to take out a credit card to meet the extra expenses they have, whether it's because they just can't pay enough for the mortgage, the car payment, the food, the gas, clothes for the kids to go to school in. They're just not meeting it. All the prices are going up. They're just not meeting those expenses. They take out a credit card. And then eventually, as they're paying on that credit card, the interest rates are high. So they've got to eventually, what do they have to do? They're going to max out that credit card. They're going to take out another credit card. And they're going to max out that credit card. Their credit score is going to go down. Their interest rates are going to go higher. And they're going to max out another credit card. And you get into what's called a debt spiral. And that's what we're in the United States. And so you can see it in all the developed countries. Look at Japan right now. Japan, they own more than 50% of all government debt, the Bank of Japan. I mean, it's just ludicrous. Their debt to GDP is well over 200% now. I mean, they're in a spiral. They've been able to perpetuate this for a long time because they have a different structural income base than we do in the United States. They're net exporters. They're an older demographic. So, but the bottom line is you're seeing it with all of these fiats. Look at Europe. All of the Europe, most of, not all, but almost every single other European country in the Eurozone is borrowing from Germany. That's a problem. They just can't stop borrowing. So they're printing more money, borrowing for Germany, and it's just not working. And eventually that will break. But the bottom line is, going back to your original question, why does it matter for the United States and what does that? Well, the issue is eventually we print so much money and we've bought so many of our own bonds that the world stops trusting the US Treasury as the reserve asset, So, and when that happens, when the Fed becomes the marginal buyer becomes the major buyer of our debt, and confidence in the US Treasury is dissolved, and it will happen. I'm not saying it'll happen in my lifetime, but it very well might. I'm a little bit older, but it very well might. But when that happens, what are they going to turn to? Gold? I mean, I think that some countries will turn to gold, but it's a manipulated asset as well. It's got so much paper on it. And that paper market is entirely manipulated. So again, all paths lead to Bitcoin. No matter what happens, all paths lead to Bitcoin because it's the only pure asset out there that can't be manipulated. It can't be manipulated like fiat money. They can't just print more. There's no target inflation rate with Bitcoin. I mean, it's just nonsensical. The fiat manipulation of money. So that's why if you own bonds, if you're one of the major players in this world that owns bonds, eventually you're going to wake up, whether you're a pension fund or an endowment or you're a hedge fund, eventually you're going to wake up and realize, wow, the better investment here is Bitcoin. And that's when everything changes. So, and eventually, I believe that Bitcoin becomes the reserve asset of all these treasuries, all of the fiat driven countries. I think that that's what happens. And I don't know if it happens in the next 20 years, 40 years, 50 years, but the US dollar, the US Treasury in particular, is headed for collapse at some point. Structurally, it just can't keep up.
Yeah, I like Hyman Minsky. I presume you're familiar with him. He's got 3 classifications of borrowing. He says there's 3 different types of borrowing. There's a hedge borrower, and a hedge borrower is somebody who can make debt payments that cover interest and principal from current cash flows from investments. So you've got an investment, it makes cash flow. That cash flow is enough for you to cover your running costs as well as make the repayments on the debt.
Which is a AAA company. That's what our best companies in the S&P are doing, right? Okay.
Yeah, it's basically when you're borrowing and you're pretty secure, unless disaster strikes your business, you should be able to pay off your debt and your interest and your principal. But then there's the speculative borrower, wherein the cash flow from investments can. Before we get to that, so the hedge borrower, I think we can clearly agree. None of the major governments, I think no government in the world is in that phase. If you look at their financial balance sheets. They do not look like cash flows can cover interest and
No,
principal.
and
Then there's
one
the
of the best
speculative
one,
borrowing.
the UK just jumped over 100% debt to GDP this year. I mean, they're all going down the path of insolvency. But go ahead, sorry.
Yeah. Yeah, and then there's the speculative borrower for whom the cash flow from investments can service the debt, i.e. they can cover the interest due, but the borrower must regularly roll over or reborrow the principal. So you're in that phase where you're able to pay off your interest, but you're not paying down your principal. So the amount of debt that you have either stays constant or starts accumulating and growing over time. So you need to keep borrowing and refinancing. You have no prospect for repaying off. All governments are clearly, at least in that phase. They're in that in the best of days. But then there's the third borrower, which is what he calls the Ponzi borrower, from Charles Ponzi of Ponzi scheme fame. And here, the borrower borrows based on the belief that the appreciation of the value of the asset will be sufficient to refinance the debt. But they could not make sufficient payments on interest or principal with the cash flow from investments. Only the appreciating asset value can keep the Ponzi borrower afloat. I think we're kind of entering in that phase at this point where your current cash flow is not enough to maintain, to pay down the principal. It's not even enough to pay down the increase in the interest. You're counting on the fact that, and particularly when interest rates rise because of monetary policy, because of inflation, you're counting on the fact that somehow some miracle is going to come and that's going to allow the repayment to allow the underlying asset, which is your economy, to grow massively, and then that's going to bail you out. Effectively, that's what a Ponzi is. If you get more and more people to sign up to your Ponzi, then you have enough money to pay off the returns that are for the current people, for the current holders. But of course, this only delays the inevitable because, all right, well, then people pay off, and then what happens next?
That's right. So, I mean, what are their options? They could raise taxes, right? So cut expenses, not popular politically. Raise taxes. Well, we both know, having studied economics, that negatively impacts productivity. So also, it's not politically favorable, because the people that donate to your programs, to your reelection, they're typically the wealthy people that you're raising the taxes on. So that's not popular, and it hurts productivity. So what's their other choice? Well, their only other choice is to let inflation run hot. And I've been saying this for a while. I think that they're going to let inflation run 4 or 5%, even if they pretend that it's not. Even if they say the CPI is down 2 or 3%, they know that it's running hotter. And what does that mean? That means that GDP goes up nominally, and they get to tax at a high, they get to tax more dollars. And so they pay off that debt. So they're inflating away the debt because they're taxing at a debased dollar, right? So as your GDP goes higher nominally, you're getting more dollars in tax receipts to pay down debt that you issued back when the dollar was worth more. So, but it only works for so long, right? At some point it breaks. It only works for so long. Yeah, it's a major problem, and that's right. It's a Ponzi. That's it. Period.
Yeah. So I mean, I tend to lean toward this perspective of yours. And last week we had Dylan on, who leans in that view. Next week we're going to have Nick Bhatia on, who's going to try and give us the kind of steelman case for why this is not a Ponzi and that this is not sustainable. If you were to try to make this case, why the treasury market is going to be all right and things are going to be okay over the next 50 years, let's say, well, maybe 30 years, let's say, what in your mind would be the best thing? So you'd say, as you said earlier, they're going to let inflation run a little bit.
But there's a couple of things. So they let inflation run hot, right? For a while. That can happen for a long time, right? So you can let inflation run 4 or 5% for a long time, even if you're not admitting it. You're manipulating the CPI basket so people don't see it. So sleight of hand, and your tax revenues are going higher. And it's not quite enough. It's not running hot enough to hurt people enough that they realize just how devastating it is for their savings, especially if they're not keeping up, on their wages. But I think most wages will keep close to that level if they let it run hot like that. So that's one thing. That's one thing they can do.
But of course, I should add here, as they let inflation rise, that also increases all of the inflation indexed benefits that the government has to hand. So that's
but remember,
exactly a solution,
remember
because
that they're only at the CPI that they're admitting to. They don't have to raise it by, so there's going to be a delta there of probably 3 or 4%, right? So we all know that if you look at the CPI from 6 months ago, it was laughable that the number that they were putting out versus the number that people were experiencing, right? So we know that. So I agree with you, but remember that that's why when people ask me, are they a good investment? Well, first of all, you can only buy 10,000 tips, right? $10,000 worth of them, which is a lot for most people. But, hedge funds obviously can't do it. They're only for individuals. But also, that's the inflation rate that they're admitting to. That's the real rate that they're admitting to. So, and it's an absolute fucking lie, right? So, okay. So there you start there. The second thing, though, is honestly, you've seen it for so long. How many people are going to pivot their thinking and really believing that the Treasury could fall out of favor? Look at everything that has happened this year. And we're watching the BRICS being assembled and put together right now. The Brazil, Russia, India, China, and South Africa, we're watching it being assembled, where they're looking for a different base current. They're looking for a different reserve asset for the world, and they're putting together this, and they've all sworn off treasuries. Who's buying treasuries now? Well, Japan can't buy them. They're a net seller because of their own problems with their government bonds and their own treasury. China, the other major buyer of treasuries, well, they've sworn off and they're not buying, they're selling them. Russia sold all theirs. So we're watching these massive players not buy treasuries. And yet, still, the vast majority of people say, oh, the Treasury could never fall out of favor. I agree that, the Treasury is, that for governments who don't print their own money, for governments who don't have enough confidence in their currency to issue their own debt, let's put it that way, they have to issue debt in US dollars, right? So that's what they're doing. And so we have hundreds of countries that have to do that. So again, it takes a very, very long time for people to believe that something could collapse, and then it happens all at once. So I think that this could play out for many, many years. And that is the argument against the debt spiral. That is the argument against, the Treasury is going to collapse in the next 10 years. I don't think it will. I have a partner that we talk, Larry Lepard. He's an investment partner, and we go back and forth on this. He thinks this is our last cycle. I think it could play out for a couple more cycles. And the reason I think that is because, think about how many people are just followers in this world. Go out and actually talk to people who are not in our bubble, who are not seeing the manipulation of money. I can just around the Thanksgiving table, surrounded by very smart people, but they're not focused on this like we are. We are hyper laser focused on this. But to the typical person out there who just has a job and is just trying to keep up, they're not thinking about this. And so, it's going to take a long time. I think that's the argument. But I don't have an argument, I don't have an argument for this to perpetuate forever. I just don't have it,
Yeah, and I think, even the most dyed-in-the-wool Keynesian, and Keynes himself, I mean, when you cornered him about the absurdity of his economic system, his final answer is, his final get-out-of-jail card is, well, in the long run, we're all dead. And thankfully, for us, he is dead. But unfortunately for us, we have to live in the world that comes after he dies. And, he's a very high time preference person who never thought much about the future, as I discuss extensively in the Bitcoin Standard. And so you can see why this kind of mentality, and you see it, the more you study his life, the more you see it. This was in World War One. He was instrumental in, which I discussed in the Fiat Standard. In World War One, the way that they financed the war was that they tried to sell bonds, and then the British people had the good judgment to not buy those bonds, because why should we get into this stupid European war that doesn't benefit us? And the Bank of England went and bought the bonds under the name of a couple of the employees of the Bank of England. And that was the beginning of the fiat standard. The idea is, well, just have the central bank buy the bonds, and then we'll just keep kicking the can down the road, and things will, one day they'll sort themselves out. It was always this kind of, we will figure out a solution today, and then we'll cross tomorrow's bridge when we get to it. And, you could argue, well, it's been 100 years and they've been kicking the can for 100 years and it's been working, so why can't they do it for another 100 years? But of course, I think here the question then becomes, well, at what cost? And then also, you keep the pretenses of, we're paying off the bonds and we're still solvent, but in reality, you look at the implications for Britain. Going from a world superpower to essentially a dysfunctional
hanger-on
American colony at this point.
Yeah. I mean, it's sad. It is.
And
it's
then
sad.
It is. And then you look at the deeper implications for society and for economic productivity. Britain had the Industrial Revolution in the 19th century, and today they're essentially deindustrializing. I don't think you can separate all of those things. And of course, the same people who tell you that this kind of high time preference, kicking the can down the road, is the right way to go around, they're also the same people who will have these very elaborate complaints about the evils of capitalism, and somehow the evils of capitalism just pertain to people buying and selling things freely on the market. That's where all the evil comes from. It has nothing to do with all of the destruction of currency and all the debt and all the inflation that takes place. That somehow is justified and needed, and we'll cross that bridge when we get to it, and let's not worry about the long-term implications. And then when you look at the long-term implications and all the actual consequences of this, then these just get rationalized away as, oh, well, that just means that capitalism is bad, then we can fix that by printing more money and having the government have more power.
But think about it. So there's the average person. The average person sees the capitalist, the bankers, the investors, the company owners. They see them getting rich around them, and they get increasingly angry at that because they're not keeping up, right? So it's an easy target for them to say, well, it must be capitalism, instead of understanding that, well, no, they're just closer to the spigot. They're the ones who are closest to the manipulated spigot, and that's why they are benefiting greatly. That's why. I mean, I know people who they're born into money. It's super easy for them just to get some money and go invest it and make more money and think that they're brilliant. They're not brilliant. They're just extraordinarily close to the spigot. They benefited insanely from this system. That's how they did it.
And of course, they can borrow against it. That's
Always.
The important thing. If you have money in the fiat system, you borrow against it. This was what Saylor really came and gave me the glue that holds all of the fiat standard together, and that what allowed me to finish writing the fiat standard was just understanding this idea that, yeah, that's how it works. It's just constantly benefiting people who get into debt. And so if you have money, you can borrow against it, and then you're constantly benefiting from the inflation rather than getting hurt from the inflation. So it's a way of rigging the game to benefit the people who already have money.
Exactly. So the capitalists become the easy target because it's the easy way out for people to think, well, that's the problem. It's not the problem. The problem is the money. The problem is the manipulation of it, period. Stop manipulating the money, and you'll stop the separation of wealth in this country. That's the problem.
Yeah. So I think if I were to make the case, the best case scenario is that this can be managed through financial repression, essentially, wherein you have fun staying poor, basically. Your bonds continue to get paid off. There's no formal default, but your bonds buy you less and less of the things that you actually want, and you have to constantly replace the things that you want with things that you are told are better. And this is essentially the central thesis of the fiat standard, that the way that the fiat standard works is that, this was what happened in the 70s, that we suddenly developed all these insane pseudosciences that started telling us, the way to fix your health and to fix the planet and to fix the weather and to not boil the oceans is for you to eat industrially processed crops and stop eating the meat that all your ancestors have eaten. And the way to fix the weather is also for you to stop using modern fuels that have built our modern world and go back to what your ancestors used as technology, windmills and sunshine, and just, rely on that. And I think we're seeing more and more of this. I don't think it's a coincidence that these things ramp up when inflation ramps up, because it's the only way that you can try and hide that inflation. So you're not eating soys and bugs because you're poor. You're eating soy and bugs because you're so enlightened and rich that you can afford to tailor your diet to save the planet. And you're not living off wind and sunshine like a peasant in the 12th century because you can't afford modern fuels that your ancestors have afforded for the last 100 years or so. No, you're doing it because you're fixing the weather. And so you should feel very proud of yourself.
Right. And you don't own a house, and you don't own a car, and you don't own it because you're helping. It's a sharing program that you're
reducing your carbon footprint.
Exactly. And then we get to the CBDC, and then the game is over. The game is absolutely over. If there's one thing that I want people to understand, it's wake up. CBDCs are not just digital dollars. Wake up. They are the ultimate evil, and they will be manipulated, and you will lose every single dollar that you make, every single ounce of currency that you make, even if it's, whatever it becomes, will be under the control of the king, and that king is your government. So beware. People better wake up. They better wake up really, really fast, really fucking fast, because they can do anything they want with those. And talk about, you've eaten 2 steaks this month, and so your carbon footprint's too high. Now you can eat the cricket burgers, or you can eat Beyond Beef, but you cannot have another steak. So your money cannot buy that. You traveled twice in the past 6 months, and you were on an airplane, so your carbon footprint's too high, so you can't travel anymore. Sorry, if you want to go see your kid who's in a different city, can't do that, because you've already spent your carbon credits. People are sleepwalking into this, Saifedean. They're sleepwalking into it, and they don't understand. I can't tell you how many arguments I hear that we already have CBDCs. They're just digital dollars. So people they're missing the boat on this one, and it's happening fast.
Yeah, and I think the key thing is that there's just really no way of separating the push toward all of those things from the financial repression,
Exactly.
From the destruction of bonds, from the destruction of the dollar, from destruction of fiat currencies. This is the way that inflation takes shape. This is the idea that I'm trying to communicate in the fiat standard. This is how it worked in the 70s. This is how it's working right now. If everybody wants to live in the standards that they think they're entitled in terms of how much money they spend, if you want to live the quality of life that you expected when you started in this current job with the current income that you have, that's going to mean way too many people buying way too many things, raising the prices, exposing the inflation. But you can keep inflation down if you stop people from eating things that are price sensitive. And this is, again, Saylor his other very important contribution to the fiat standard was the idea of thinking of inflation as a vector. It's not a single number. The notion that you can summarize all of inflation as a number is ridiculous. Inflation is more like a vector, where it's and it changes from one good to the other. So the goods that are actually desirable, real estate in areas that are nice, food that takes time to grow because it's natural, healthy food of cows actually out there grazing in the fields, getting sunshine and getting proper feed. That's going to be expensive because there's no way to rush it. Whereas industrial things can be made cheaper. They continue to increase the productivity of industrial processes, so they can continue to get cheaper and cheaper. So therefore, industrial food is not something that's very price sensitive. The price of Coca-Cola doesn't go up as much as inflation. The price of Doritos and Pringles, these things are relatively easy to make. You can just ramp up the production and meet increasing demand, and then prices don't go up as much.
Yeah, they're mass produced. Yeah, exactly.
Exactly. So digital goods, of course, are the best in this. Digital goods are deflationary or price deflationary in that the price continuously declines. The price of a megabyte of storage continues to go down no matter what happens with monetary policy. We just keep getting better at making it, and the factories become more productive, and the capital that has been invested is paid off, so the company can now charge less and less for the output of the factories that it has.
Which is another mind game, because people see, well, I've got this new iPhone and it's not as expensive as I thought it was going to be, and it does so much more than, yet they can't afford what they could in food just last month.
Exactly. So as long as you focus people's consumption toward the digital and the industrial, you can hide inflation significantly. And so where the inflation really shows up is in food and in energy. That's where thermodynamics and nutrition can't be cheated. You need your nutrients, and nutrients need to come from living things. They need to come from the natural processes of life. Although, of course, these criminals on modern nutrition departments are trying to feed you synthetic garbage, which, defeats the entire point of food. Like, the whole idea of food is that it comes from living creatures, and they're trying to feed you synthetic garbage because that would be the ultimate anti-inflation policy. Right. If they manage to just feed you industrial waste, then you're done. There's no inflation ever. But you can't cheat nutrition, and you can't cheat energy.
Yeah, as Europe is finding out in a very difficult way in the last year, and it's you can't print energy.
Yeah, that's what it comes down to. So I mean, I don't know how it plays out. Obviously, I don't have a crystal ball, but I think we're going to see more and more of this. More and more of your life is going to need to go to more and more of your consumption, and the BLS basket is going to head toward digital and industrial mass-produced goods. And more of our education system and media and all of this gaslighting industrial complex is going to continue to insist that you must eat the bugs, stay home, don't drive, live in a small house, minimize your carbon footprint. You are the carbon that they want to reduce.
That's right. That's exactly right. And, our challenge is to stop people from sleepwalking right into that path. That's the challenge. So we need to just find ways to educate people so they understand everything that's going on around them and don't just accept what they're being told to do. And it's hard. Most people are sheep. Reality. That's a hard reality. But, it's worth it. It's worth all the energy putting it out there. It's worth it. And and you said something that's really important is, Keynes, he just thought, well, we're all going to be dead. It doesn't matter. Yeah, well, my kids are going to be alive, and I want a better life for them. I don't want them to be dealing with this only getting worse. I want a better option for them. And that's why we're doing this.
That's why we're into Bitcoin.
That's right.
That's really what it comes down to. It's fascinating just how common these themes are amongst people who get Bitcoin and how rare you find them everywhere else. I mean, it's very, very rare. Daniel was telling us about this trend among boomer parents. Something they call it a ski vacation. And ski isn't specifically about going skiing. It's spend kids' inheritance. And now this is it's all the rage among retired boomers who have just decided, hey, why give people an inheritance? Why not just spend it all on conspicuous consumption today? And I think it's a very common way of thinking in the fiat generation. This particular fiat generation, I mean, they've saddled their children with massive amounts of debt, and they've spent down the savings of centuries of their ancestors. You look at a place like England. In the 19th century, they had such high savings rates, and the savings rate had been declining constantly in the 20th century, and now they're basically non-existent. And now the savings exist in the forms of bonds that are being destroyed. And moving forward, this is just going to be less and less that's going to be handed over. It's truly the reversal of the process of civilization, and that's the subtitle of my book. The fiat standard is the debt slavery alternative to civilization. Everybody becomes a debt slave. We get rid of the civilization, because what civilization is, what you just said, you want your kids to have a better life. You don't want your kids to suffer from these problems. That's what civilization is. The only reason civilization exists is because people have kids, and then they focus on this objective. I want to give my child a life that's better than mine. If you live in a society where everybody thinks like this, children end up predominantly living lives better than their parents. Then you have civilization. That's it. That's kind of the punchline of my next book, Principles of Economics. And fiat is truly destroying that, because it's taken away from us the ability to give our children a better life. And it's raising our time preference so much that we see so many people don't even have that desire or intention. Like, why should I give my children a better life anyway? Why shouldn't I just spend the money and let them fend for themselves?
And that's a disease that needs to be rooted out right there.
Yeah.
It's a mental disease.
In one of your other newsletters, you discussed the Plaza Accord, and this is something that we've also discussed here a couple of times before in the pod with Caitlin. What are your thoughts on this? So one other thing that we've been noticing over the last year, it's reversed over the last month or so, is the destruction in the value of fiat currencies other than the US dollar compared to the US dollar. So we're seeing all of these foreign currencies lose value against the dollar. The dollar's been on a tear internationally. And so when we think about the bonds of a place like Britain declining in value, they're not just declining in value in nominal terms against the British pound. The British pound itself is declining in value against the US dollar, which itself is declining in value against normal goods and services. So if you're a British retiree, you're getting robbed on three layers. And you suggest that this might be the cause for a new Plaza Accord. What are your thoughts on this? What do you think of this?
Yeah, I think there are people who are calling for a new Plaza Accord. So the Plaza Accord was it was an agreement in back in 1985 between it was the UK, West Germany, France, Japan, and the US. And what had happened was the US dollar had appreciated so much against all these other currencies that our interest rates were rising, and the Fed was battling inflation, right? The inflation was getting almost out of control, right? So they were attracting investment with higher interest rates. And you know this, but for your listeners, basically there's something that's called interest rate parity. And what happens is, if your interest rates are higher here than they are in another country, well, you'll attract money into these interest rate vehicles, right? So people were buying our bonds for the higher yield. And that's what interest rate parity is. And so your dollar was going up against other currencies. Why? Because they were selling those bonds that they owned in this currency, and then they were getting that currency, selling it and buying US dollars in order to buy our bonds. And that's what happened. So the dollar was getting stronger. And so it was getting so strong that it was actually hurting our exporters, our Caterpillars and GM and Fords of the nation, the automakers and equipment manufacturers. And so they got together and they argued that we should do something about the US dollar increasing so much. And so they lobbied pretty heavily to protect themselves against foreign competitors, saying that, people can't afford our equipment, our cars, because they can't afford the dollars, because their currencies is getting decimated. So they argued for these countries to get together and to wage an attack on the US dollar. So they sold the dollar down pretty heavily, and it worked. It worked. The dollar went down. I want to say it was like 40% or something in just a few years. And so people are saying, well, the same thing needs to happen now. The US dollar needs to have, we need to have another Plaza Accord, a Plaza Accord 2.0. And the reason they called it that, by the way, is because when they struck the agreement, it was in the Plaza Hotel in New York. People asked me, they were like, why is it called the Plaza? So that's why. I doubt they'd even meet in the Plaza Accord, in the Plaza now, if they tried to do an accord. But, first of all, the dollar is coming down, and the reason is it went up to, it went pretty strong. It got over 115, the DXY in that basket. But if you look at it, that's nowhere near where it was back in the 80s, number one. Number two, there are different countries that are that would be in the Plaza now. So there is no West Germany anymore, right? So Germany is part of the euro, right? So and same thing with France. So our major trade partners now are the EU, the UK, Japan, and China, right? But there's no incentive for China to come to the table now. They have their own issues, and the last thing they want is for a weaker dollar against their currency. They want the strong dollar because it's better for them. That's structurally, as an exporter to the United States, it's better for them. So I just don't see that happening. Truly, number one, I don't think that we're in the spot where that they would never even come to the table. So it doesn't make any sense. Without China, what does it matter if you're trying to make the dollar weaker against other currencies? So, but it's happening. You've seen over the last number of weeks, it's happening a little bit naturally. The dollar is back under 110. I think it's 105 or 106 now on the DXY. And for anybody who's wondering, in the Informationist, I wrote about the DXY and how it's structured. And if you want more information about it's on there. It's free. The Informationist, you can go check it out there. But the bottom line is, no, I don't see another one happening. And I think a lot of these countries are just kind of playing chicken with the United States. I mean, Japan's a great example. Japan they announced that they are keeping their interest rates low because they want higher inflation. They need higher inflation for their economy. So clearly they've got a 250% debt to GDP. So, but when they did that and they've held their 10-year treasury to a 0.25% return, interest rate, they did that by manipulating the market, by getting in there in the Bank of Japan, buying every single bond in order to keep that interest rate artificially low. Well, when they're doing that, while they're doing that, the Fed has been raising rates, and our 10-year got to 4%. So obviously, anybody who owned Japanese 10 years were selling those, getting yen, selling yen, buying US dollar, and buying the 10-year treasury. Why? Because they could make a better return here, right? And so that was the play. And so it put tremendous pressure on the yen, to the point where the Japanese government that owned at one point $1.2 trillion of treasuries, those were down in mark-to-market terms, but they had to not replace them. So they were letting them roll off their balance sheet. Number one, they couldn't rebuy US treasuries, and now they became a net seller. So they're selling US treasuries in order to support their currency. But getting back to that point is that they're playing a game of chicken. They're saying that they can sustain this, they can weather this, and wait it out for the US to start, entering into recession, and for the Fed to stop raising rates and eventually pivot off of the higher interest rates and that'll bring down the strength of the dollar. And you're seeing it in the last number of weeks that, we've got a number of dovish comments out of Fed governors that they're saying, the question is how fast can they go? How high can they go? And so you're seeing, and our housing market coming down, and questions on the employment market. So PMI, you're seeing some of these conflicting measures of our economy. The major investors are backing off of buying or backing off of those treasuries, and they're starting to buy them because they think that the interest rates are not going to go quite as high as people thought last year. And so as the interest rates of our benchmark 10-year, as that comes down, then the US dollar gets weaker. And as it comes down as compared to other interest rates, European interest rates, the UK, Japan, then the dollar will get weaker. And that's what the countries are playing, the game of chicken there. So that's kind of where we're at.
Although, if you look at the yield curve, it is heavily signaling a recession because it's massively inverted, and it's. This is a sort of thing that people like to argue about, and a lot of fiat people insist that it's just a coincidence that every single time we've had an inverted yield curve, we've had a recession after it. From the Austrian perspective, it's not so much that an inverted yield curve predicts a recession. It's more the fact that an inverted yield curve is the recession. It's the beginning of the recession. Because if I were to summarize this very briefly, from the Austrian perspective, what sows the seeds of the recession is the inflationary monetary policy, the monetary expansion, which creates relaxed lending standards, so people borrow too much, and unsustainable businesses will be still able to be getting credit, and that makes them borrow too much. And then when interest rates rise, you get a liquidity crunch where these people are unable to meet their short-term funding needs, and so that creates and
not only that, but companies are less profitable. Banks are less profitable, because they lend out at rates that are lower than the rates that they're being paid on. So it structurally doesn't work, right? So, yeah.
Yeah, and so that creates a flight away from the long-term bonds and a flight to the short-term bonds, because when you're unable to make payroll next month, you don't really have much use for a 30-year and 20-year treasury. And so you're more likely to want to hold things that are shorter. And so that then makes the yield inverted. It makes the yield curve inverted because the yield on the low maturity, low duration bonds rises above the one for the short duration bonds. And that's basically the signal that we are in a recession. So it looks like we're getting into a recession, and if this happens, usually again there's the school of thought that says, well, recession, everybody's going to go away from the currency. But I think the last few have shown that there's more demand for the dollar. So when there is a recession, people move away from risk assets and they want to hold more cash. They need to take less risk with their holdings. So they liquidate the things that are the most risky. They liquidate the most speculative things, like, say, mortgage-backed securities previously, or cryptocurrencies currently, and move toward things that are more reliable, which in most cases is going to have to be the thing in which your paycheck is denominated and thing in which your rent is denominated. So that leads to a rise in the dollar.
Yeah, and there's so many countries, like we talked about before, who need dollars because they have dollar-denominated debt, so they have to have dollars. But it balances. There's a balancing that occurs there with the interest rates between countries too. And so as our interest rates come lower and they come back into line with the interest rates around the world, then it also balances it out. So that's right.
Yeah, and so you think that there's not going to be much dollar strength moving forward, or some?
Well, I mean, I think that no, I do think that there's going to be more dollar strength, especially as we, as some of these other fiat based, currencies, countries, as they falter, it's going to be interesting to see what happens in Europe. I talked about this before, the deficit that Europe is running on Germany, it's incredible. And the rest of the Eurozone owes Germany over $1 trillion, and it's only growing. And that's because of manipulation. Because the the European Central Bank, the ECB, they're buying treasuries of the weaker countries in order to manipulate that yield curve to prevent exactly what you're talking about. And so to do that, they're having to borrow it from Germany, and it's causing a structural issue there. And the issue there is that it's something called Target 2, where they have an overnight settlement system. And so between countries. So if a country is borrowing money in order to settle out some sort of transaction, then it gets put on this it just gets put on a record. And it's the Target 2, it keeps track of that. So all money kind of flows through the ECB and out the other side, but the ECB just keeps a record. And so they keep borrowing from Germany and letting Italy and Spain and Portugal. Italy's the worst offender now. And so they're running, they owe like $600 billion to the other countries, mostly to Germany. And so, but there's no mechanism for that to be paid back. So getting back to your point, I do think the dollar is going to be stronger. It's going to continue to get stronger, but I don't see a mechanism for a Plaza Accord. I don't see the necessary trade partners coming to the United States to fix it. I mean, Japan's already doing it on their own because they have to, but if you don't have China in that equation, it just won't work. It doesn't matter. So, but I do see, we'll go back to what's called the dollar milkshake, and that's Brent Johnson's theory, from Santiago Capital. And that's the US dollar, because there's so much debt, there's so many transactions that are denominated in US dollars around the world, that it's like a milkshake. And so the theory goes, and I think he explained it in that it's kind of like, it goes back to the old oil drilling days, where if you saw there was a great property over here, you would buy the property next door and then drill a really long hole across into that next property and suck some of that oil into your own property, right? And so that's your straw. And so what he likens it to is the US dollar, you and I are sitting in a diner. You're all the way across the diner and you're drinking your milkshake, and that's your currency. And I'm the US dollar and I'm sitting over here, but I've got a really long straw and I can drop it into your milkshake and pull that into my own. Well, in this instance, your milkshake is the foreign currency. The straw is all the US dollar denominated liabilities, the debt, the euro dollars, those bonds that we talked about that other countries are issuing in US dollars. And so the US dollar has the strength to just suck that liquidity out of all the other currencies into its own. And that is definitely happening. And that will continue to happen. And the first countries to go will be the undeveloped emerging markets that don't have their debt denominated in their own currency. And then eventually, I think the countries in the Eurozone will falter. Germany will eventually just get up and walk away. If there's no mechanism to pay them back, they're just going to get sick of everybody else living off of them and creating an economic system that is stacked against them. So they're working in order to benefit the rest of the Eurozone rather than themselves. And eventually, I think that changes and they walk away. And so what happens when the Eurozone breaks apart? Well, I think a lot of that money just dumps into the dollar while there's so much uncertainty. And that will occur. To me, I think that's going to occur in the next decade. I don't know anything, but that's what I see. And so, yeah, I do think the dollar gets stronger. I agree with you 100%, but I don't see any impetus for there to be a Plaza Accord 2.0. I don't see that occurring.
Yeah, I mean, I think politically the world is a little bit different. The world is a lot less unipolar than then. I mean, well, there was the Soviet Union back then, but the non-Soviet world is a lot less unipolar. Having said that, I think if I were to make the counter argument, I'd say the world was surprisingly unipolar when COVID came about and everybody got together in line and started listening to what the World Health Organization was saying. In my mind, I don't think it's entirely inconceivable that we could get something similar with all of this great reset stuff, a monetary, I think a central bank digital reserve currency, something issued by the IMF, and global major central banks as a global reserve asset that is then held by central banks who then issue their own currency backed by it. And it's a way to bring in CBDCs, perhaps something.
Yeah,
like
but think about how much power the United States has, and I don't disagree. I think that they.
Yeah, I'm not necessarily saying that's going to be a U.S.
I think they
thing.
want it. Yeah, 100%. The IMF, I think they want it, but the WEF, and that's the easiest way to get us all to eat bugs. I mean, truly, to not own anything, the CBDC. But I think the U.S. is going to fight against that because it structurally impacts us so greatly that it dismantles our power, our leverage over the rest of the world. So, but I don't doubt that they want it. They definitely want it.
Yeah, I think I'd have been a lot more skeptical about their chances of getting it before COVID. After COVID, and watching how, I think it's the scary thing is, like, you ask all of the world's intellectuals and all of the world's thought leaders and all of the world's opinion makers and politicians, if you ask them in January 2020 and you told them, hey, there's a bunch of people getting sick in China, assume this turns out to be a massive pandemic, what do you think should be done? And everybody from the health experts to the politicians to the intellectuals to the economists, everybody who was a hysterical bitch in April 2020 would not have told you that they would want to do what was happening in 2020. But once people are gripped by fear, then they just become completely pliable. And the role of a public intellectual in fiat world is simply to take down instructions from authority and rationalize them to their audience. So your role as an intellectual, if you look at, all of those people who play intellectuals on TV, like Richard Dawkins, Sam Harris, Nassim Taleb, Nate Silver, all of these economists and statisticians, like Emily Oster, who got a lot of heat the last few weeks for talking about getting into pandemic amnesty. If you look at what all of those people do, none of them in January would have told you that they would support mandatory masking, lockdowns, mandatory medical treatments, which I'm not going to say because of censorship. They wouldn't have said this is what you should do. But once this was the current thing, once they were scared, then they just it's Pavlovian. Like, what you do is you go on TV and you explain to people this is what needs to happen, and you use your ideas and your audience, whatever stupid garbage you usually publish and you usually write about, you just use your tools and tricks and ideas to then portray the same thing that CNN is saying. So, whether it's Sam Harris.
What's so telling about what you're saying, and what really upset me early in the pandemic, is seeing some of these experts get up in front of cameras and having the whole world watch them. And they were excited. They were happy. They were smiling, telling you all these terrible things that were happening and you need to do. Why were they so excited? Because they were getting all the attention. And it was sickening. I was like, why are you smiling? This is not funny. This is not enjoyable.
Yeah, you could see so many of them all over the world. Like, they just got such a kick out of it.
A rush.
And this is exactly. And then because, these are the nerds in the class finally get to have some respect, because now this is just the current thing. So I think the scary thing here is if inflation gets bad and economic problems become bad. And I think, we had a dry run in 2008. If you think about 2008, after having gone through 2020, 2008 looks a lot clearer about what happened. Like, realistically, yes, things were bad on Wall Street, and the LIBOR market froze up, and this and that, and all of those bad things happened. But let's face it, like, realistically, if the central bank and the treasury all over the world decided, you know what, you guys are all on your own, sort it out, what would have happened? I mean, yeah, it would have sucked to be a billionaire who's got billions of dollars in Goldman Sachs and Morgan Stanley. You would have probably gotten, say, a 90% haircut. So you'd have gone from being a net worth of $10 billion to having a net worth of $1 billion. I mean, it's catastrophic, but you're still a billionaire or, a millionaire. You're not going to go hungry. Like, if the US government just said FDIC insurance for everybody, even in the, let's be generous here and say, even in the shadow banking system, your first $250,000 are on us, and everything else, let the chips fall wherever they may. Like, if that had happened, the horror that was being portrayed, the scariness that was being manufactured by TV of this idea that unless we bail out those billionaires, then tomorrow
the whole financial system collapses. Yeah, no.
Not just the financial system, the supply chains. There's not going to be bread in the supermarkets. There's not going to be meat at the butchers. So we need to make sure that all of these financial institutions of highly leveraged billionaires and hedge funds continue to make their enormous bonuses this year, or else you won't get to eat. I mean, now, after coronavirus and all of the hysteria that we saw there, this is just clearly it becomes clear what was going on. Like, you just had the propaganda machine commandeered to try and get people to accept something that they would never have accepted unless they were freaked out. And that's basically the recipe. Scare people, and then if they're scared, they will accept things that they would have never accepted. It's true.
And it's so easy because you get on the mainstream media news cycle, and they make money from fear, period. And there's no way around it. So it's just so easy to use them as puppets to just get across whatever they want to get across. And you're right. We should have let those banks collapse. We should have let some banks collapse, I mean, it's sickening to think of all the money that some of the people,
It would have been enormously beneficial for everybody else in society. I mean, yes, a lot of billionaires would have been hurt, but, think about all of the real estate that's being used up in all of these financial institutions that don't do anything except generate money by printing money out of thin air, by lending it out. All of these people would have been replaced by actual productive businesses. You'd have had brick and mortar buildings that they take up, and computers that they use up, and smart engineers that they use up. We would have had a lot of intelligent talent move from this, yield chasing hamster wheel to making useful things over the last 10, 12 years. It would have been a lot better for the world. It would have meant a lot of deflation. So real estate prices would have crashed, which would have been enormously beneficial for the generation that came of age over the last 10, 15 years who can't buy houses. When you think about why is it that people can't buy houses, because the financial industry got bailed out, and so all of these millionaires and billionaires now have tens and dozens of houses that they can rent out.
Exactly. And not even that. It's the individuals, the billionaires, but it's also the BlackRocks and the Berkshire Hathaways and the Allianz. They're in every single city. Yeah. They're buying every fucking house that is open. It's ridiculous.
This was all the seeds for that were sown in 2008. 2008 was the chance to nip that in the bud.
Yes.
And instead, it was put on steroids.
It made it worse. It's infuriating.
Exactly.
It's absolutely infuriating.
And all of that comes back to, the fear that when you just turn on CNN and there's all these ugly graphics that are telling you, people are dying from the virus, or people are livelihoods are being ruined, or the banks are going to collapse, or the LIBOR rate is rising. Like, none of those people who supported those measures in late 2008 would have told you this is what needs to be done. And I remember this was like my awakening moment, and I was just getting into Austrian economics, and this is when all of it started to make sense. I'd see how those economists, today they'd be telling you, all right, so this is what's going on, and now the central bank did this because it's going to fix it, and now things are going to be better. And then the next day, something completely unexpected happens, And then they come at you and say, oh, yeah, well, now they need to do this because that's what's better. And now things are going to be fixed. And like at every point in time, they were getting their call about what's going to happen wrong. And at every point in time, they were coming up with a justification for things that need to happen that they would not have wanted earlier. So watching how all of these economists in unison start singing from the same hymn sheet, which none of them would have suggested the day before, is really, I think, the worrying thing to go bring us back to the CBDC discussion. Like, it seems completely outlandish that they would do something like this right now, that central banks could introduce something like this right now. It's not going to be outlandish if inflation is high and bonds are collapsing and CNN is going on, and then all of the current thing energy is focused on the financial collapse. Then you can get all of this stuff passed in 15 minutes.
Sure. Look at how, if you just Google transitory inflation, look at how many people fell in line to say, oh yeah, it's just transitory, it's supply chain issues.
Yeah,
it's incredible. So they're mind games, and it's really, if you talk to Jeff Booth, it all goes back to just look at the system and what they're trying to protect in the system. And nobody can think outside the box of the system. It's very difficult to see a future that doesn't involve the base case of where you've lived all your life. And so it's extraordinarily difficult to get people out of that mindset. And so when you have a few, 1,000 people who are saying the same thing over and over and over again, who are supposedly the experts, who are supposedly the leaders, the thought leaders, but none of them are critically thinking, well, that's where you get led right down the path to destruction. And so, yeah, we need more critical thinkers. Safe. We need more people who will actually think for themselves.
Yeah, absolutely. It's an individual thing. I think it's not so much that we as a collective need it. I think every single person needs to do it for themselves, because I think if it's not obvious to you at this point that when you go along with the herd, you're not going along for what's for you.
And you will get made fun of. You will get ridiculed. People will say you're crazy. People will say that you're weird. You're just coming up with wild conspiracy theories. It's not a conspiracy theory that they want us to have zero control. They want to have control over everything that we do with CBDCs. It's not conspiracy. It's obvious. It's obvious once you actually critically think about it and do the work, period. And it's for everybody to do. I agree. Yes. Yeah.
So everything we've said so far has been basically a subliminal advertisement for Bitcoin. So there's no need for us to go and rehash the fundamentals of why Bitcoin. But I'm curious about one thing that you said, which is that you're starting a new fund interested in investing in Bitcoin. So I wanted to ask you a couple of things about it. First of all, where do you see the case in investing in companies other than just holding over buying sats? Why not just buy sats? And what is your case for not just buying sats and instead investing in the picks and shovels? And what kind of picks and shovels do you see as the investment case? And obviously, I understand it's still in an embryonic stage. So if you're not comfortable discussing details, that's also perfectly fine.
Yeah, I mean, there's only so much I can say, right? But I think there are a lot of Bitcoin companies that are important. Making Bitcoin a medium of exchange, actual currency that people can use, and that takes infrastructure. It doesn't just happen that we each have a phone and we can, it takes infrastructure to do that. It takes solid, trustworthy companies to do that. All of those lightning companies, there are cases for you to have all of your savings in Bitcoin in the future. Every single dollar that you make goes into Bitcoin, or whatever currency that you're in. However, what do you do when you need liquidity? Do you just sell that Bitcoin, or do you actually, is there a way, are there companies out there that have it actually escrowed in multi-sig, multiple signature, third-party, trustworthy places where you can actually borrow against it? Are there cases for that? Absolutely. We need companies that will allow you to buy houses through Bitcoin, that will allow you to, financing anything you want to do. but we've got to have companies that'll do it in a different way than what the fiat companies have been doing. We can't have any more FTXs and Celsius. It's untenable. We need companies that will do this in a way that is actually trustworthy and can be proven that your assets are what they are, where they are. And so I think that there's, and then of course there's mining. There's the mining companies that are struggling right now because the prices have gone down. They bought all these ASICs. They got way over their ski tips on leverage, borrowing money against the assets that went down in value because ASICs are tied to the price of Bitcoin, the price of ASICs. And so, and for your listeners who don't know what ASICs are, they're the computers that actually solve the algorithm in order to mine the Bitcoin. So there's some what we call distress in the Bitcoin world right now, and a lot of it is just because Bitcoin has been associated with all of these other garbage coins out there. And so there's been a lot of pain, and people had levered themselves in order to buy all these other things that went to zero. And now Bitcoin is it's taking, it's been, the price has been impacted negatively because of that. And so that's hurt a lot of these companies. So they had their venture rounds or early rounds where they were, they financed their operations at a valuation that can no longer be, you can't argue for a valuation like that anymore because it's a different world. But these are still good companies that need money to move forward. And so I can't say too much because it's an SEC regulated fund, but I can say that I want to go out there and help these companies, and I've got some good partners with me to do it. So and we're excited, and that's all I can say. I want to help the ecosystem, and this is where I want to spend the remainder of my career.
Excellent. Yeah, would have been nice to get some free alpha, but I tried at least.
Nothing's free, Saif.
I know, absolutely. If it's free, you're the product.
That's right.
Yeah. All right. Anybody else got any questions for James?
Great. Really enjoyed the conversation as always. So thanks for all your insights.
Sure. Absolutely. It's good to see you. So Lynn and I spoke a few days ago. Very smart. You're down in Mexico City.
Right. And I really enjoyed this whole group too. I'm not super contributory in here, Saif, but I really enjoy all the sessions and the guests. I mean, just an incredible group of guests that are in here. So I was really happy to see you here. It's my birthday today, so this is my birthday gift.
Happy birthday. Happy birthday. I won't sing for you. That's not one of my talents.
This was better.
This is your music.
It's awesome. Well, it's good seeing you. Thank you for saying hello, Lynn.
Marquita, you want to say something? You want a question?
Yeah, just quickly. I came in a little late, but right on time, because I think you were talking about stay-at-home moms and how, or not necessarily stay-at-home moms, but how the family unit is compromised because women essentially have to work as opposed to having the luxury and I think privilege of staying at home with their children. And so since you were talking about CBDCs, I just had a quick thought. Like sometimes when I'm with other mommies and we have these play dates and, I want to bring up Bitcoin. I want to bring up savings. One of the main things is they're always afraid. There's so much fear that they would have to go back to work, or they want to contribute more to it takes some of the stress off of their husbands. Mm-hmm. There's so much concern out there for these mothers, and then they're stressed, and then that carries over into the energy that they also spill into their families. And so for me, I found Bitcoin to be a huge relief, whether we're at that 100K or 1 million price now or not. I have hope, right? I believe in the future, and we talked a lot about, you guys talked a lot about doing something that's better for the future generation. And so in my conversation with these mommies, I find it very difficult to break down a lot of the things that I learned on this seminar, a lot of the things that I'm reading and staying away from mainstream media. And so that was a long-winded way of asking, do you have a way of delivering like just a top 3 reasons or a top 5 reasons why we need to adopt Bitcoin? Like, why would this be important for your children? How would this help your family? How would you be able to do something? Because moms always feel like they're not doing enough when they stay home, even though they're doing a tremendous amount. But society makes you feel like you're not doing enough, or you know.
Those are great questions, and I, my kid's mom, they stayed home. She stayed home with them for a number of years, and it was super important. And I feel it was absolutely critical for my kids to get the kind of learning environment, just a positive and healthy environment for them to have their mom there as their primary caregiver every day. So I think it's incredibly important role. So good for you. And I understand exactly what you're saying. And as far as talking to people about Bitcoin and getting them to understand it, what I really try to do is I ask them, like, well, what do you think about inflation? Like, are you feeling it? Where are you seeing it? Like, and talk about inflation. And that's a really easy thing to just break the ice with, and how terrible it's been. The price of gas has gone up. The price of meat has gone up. The price of milk, the eggs. I mean, eggs, really? $5, $6 for a carton of eggs? Are you kidding me? Like, that's just ridiculous, right? So those are easy things to point to and say, why do you think that is? Why do you think that we have inflation? And then the simple answer is because the government prints money and gives it out to people who are closest to the government. The super rich, wealthy people, whether they're in banks or they're in investment funds or whatever, they are the closest ones to that spigot to benefit from that. And like Saifedean was saying, they're able to borrow because they have enough money. They can borrow, and they can use that in order to make investments, and those investments just drive asset prices higher. Everything is more expensive, and it's because of the manipulation of money. And so just what I try to do is lead them down the path of, do you feel inflation? Do you understand why that is? And do you understand the manipulation of money? And once they really get to understand all of that, then you say, Bitcoin is the one form of money. It's the purest form of money that cannot be manipulated. And then you can just go into how it's decentralized, it's immutable. There's only a certain amount that will ever be made. And then they understand, and it'll just click eventually. It might take 2 or 3 times, but eventually they'll click and they'll go, okay, so how do I buy this? And then you make it really simple for them. And make sure they get it off the exchange eventually, very quickly. And you don't look. I'm an investor. I'm a risk manager. I've been doing this for far too long for me to see something and put all of my money into it. I'm just not like that. I just can't do it. But what I would say is anybody who has discretionary capital, who has investments, a portfolio of investments, just put a few percent into it, 1%, 2%, 3% into Bitcoin of your invested capital. And, eventually you'll want more. But as a start, what if we're all wrong? What if Saif and I are just absolutely horrifically wrong, and there's some way that Bitcoin is devastated, which I don't think there is. I truly don't, but non-zero chance, right? Okay. So you lost 1% or 2% or 3%. But if we're right, which I believe that we absolutely are, you're going to make 50 to 100 times that 1 or 2%. And it'll not only save your portfolio, but it'll make you wealthier on the other side. It's simple as that. So I hope that answers your question.
That was great. Yeah. No, thanks.
You're welcome.
James, thank you so much for joining us. And I'm sure there's going to be a lot more fireworks in the bond markets and the fiat markets in general over the coming months and years. So we're going to be definitely having you on again to explain and break it down to us.
I'd be happy to come on anytime, Saif. So thanks for having me. It's been enjoyable. I loved our discussion, and I'm glad we hit on so many good topics. So I look forward to the next time.
Awesome. Take care. Thank you.